Can you make a contribution to a Roth IRA? Not if you make too much money. The better question might be, how much money is too much money? Hi, I'm Antonio Cibella with Vision Wealth Management. I'm a financial advisor who works with everyday folks to help them navigate a complex financial system. Today's complex financial topic: Roth IRA income limits, when you make too much money to contribute to a Roth. And so we're going to go over three topics today. The first one: what are the Roth IRA income limits? Topic number two: who do they apply to? They apply differently for different folks, and so I'll explain that. And then three, I'll get into a real world example. We'll get down into the weeds and actually look at what this looks like once you hit the dreaded IRA income phase out. So here we go, let's get started. First off, in 2023, as I'm recording the video, the maximum contribution that you can make if you qualify is $6,500 per year. If you're over the age of 50, you can put an extra $1,000 in. So now you're up to $7,500 per year per person. So when we're talking about married couples here and we get into maximum contributions, that would be $6,500 per person. If you're single, obviously you're one person, so $6,500 for you. If you happen to be over the age of 50, married or single, you get an extra $1,000 that can go in, so $7,500 per person this year. That's the most. That's the best case scenario, assuming that you're below the income threshold. If you're married and you file a joint tax return, which is what most married folks do, and you make less than $218,000 in modified adjusted gross income. Modified adjusted gross income is a specific income calculation. If you make less than $218,000, then you're able to make a full Roth IRA contribution. Again, $6,500 per person, married filing joint. If you're single, it's a different number. If you're single, it's $138,000 per year. Again, modified adjusted gross income. So you can make up to $138,000 and make the full contribution. Once you cross over that threshold, $218,000 married filing joint, $138,000 single, you start to get into the phase out. The phase out is a mathematical equation where you can start to make a lower contribution. You can't make the max, but you can still put something in. And the phase out range is between $218,000 and $228,000 for those married filing joint. It's between $138,000 and $153,000 for the single filers. So if you're in that range, 218 to 228 or 138 to 153, you can still put something in, but you can't put the max in. So what happens when you get above those phase out levels? $228,000 is the top of the phase out limit for married filing joint. Above that, no Roth contribution for you or your spouse. You're not allowed to put any money into a Roth. You make too much money. If you're over $153,000 modified adjusted gross income and you're filing single, too much money. You can't put any money into a Roth IRA. Now, there may be some other vehicles. Maybe you look at a backdoor Roth contribution. We've got some information about that. But for a true Roth IRA contribution, north of 228, north of 153, can't do it. Not allowed to do it. You're over the limit. Retirement pitfall alert. Here's a loophole, and not a good loophole. If you happen to be married filing separate, you're married, but you file separate tax returns. Most people don't. Most people who are married file joint. If you're married filing separate, really difficult to get a Roth contribution in. And the reason is, if you have more than $10,000 of modified adjusted gross income, no contribution for you. So if you're north of 10, now that's a lot less than the 218 that we're talking about, or the 153 that we're talking about, any of the other numbers that are in the video. $10,000 is your limit. If you're above that, no Roth contribution if you're filing separate. Something to be aware of. Don't get caught in that trap. Here we are, we're at the third point of the video. Time for a real world example. I'm going to give you a disclaimer up front. This is going to get math heavy, but if you're one of those people that falls in the phase out, it's good information. So sit with me here and understand how this sort of thing works. I'm going to give a real world example of an individual making $150,000 per year. We know that the phase out starts at 138. It ends at 153. There's a $15,000 income range there where you can still make some contribution, but you can't make the max. If you cross over that 153, you can't make a Roth contribution, period. So you're going to start with the modified adjusted gross income. In this case, $150,000. You're going to subtract the beginning of the phase out range. Again, a single person. The phase out starts at $138,000. So you're going to take $150,000 of income minus $138,000, which is the start of the phase out range. That leaves you with $12,000. We're going to take that number, 12,000 in this case, we're going to divide it by the $15,000 phase out range. That's going to give us a percentage, in this case, 0.8 or 80%. Again, you're 80% of the way into the phase out range. Now, what that really means is they're going to take away your ability to contribute 80% of the max, because when you start the phase out range, you're able to put the whole thing in. By the time you get all the way out of the $15,000 range, you can't put anything in. And for every dollar in between, you can put a little bit less money into a Roth IRA. And so in this case, you're 80% of the way through, which means you can eliminate 80% of your contribution. You're only going to be able to put in 20% of the max being, in this case, $6,500. So to continue on with the math, as the IRS tells us, you're 80% of the way into the range. You're going to take that 0.8 and you're going to multiply it by the maximum contribution. 0.8 times 6,500 equals $5,200, $5,200. Now that's not the amount you can put in, that's the amount you can't put in. And so then you take that, subtract it from the max contribution, $5,200 minus $6,500 equals $1,300. That's the amount that you can put in, $1,300. That $1,300 represents 20% of the max contribution. And the reason it represents 20% of the max contribution is because you're 80% of the way into the phase out range. Remember, once you hit that phase out threshold, every dollar that you earn means less money that you can put into the Roth. So in this case, $150,000 of income means you can still make some contribution. When we math it out, how much of a contribution? $1,300 of a contribution. There you go. I hope you learned something. You might have to rewatch that section of the video if you're one of the phase out folks, because I know it can get a little bit tricky and math it out as you're going through your own circumstance. But I hope that that gave you some idea on how things were. Disclaimer, I'm sure the compliance folks are going to make me put this up on the screen as well. This is not tax advice. Consult your tax professional for tax advice. This is information about how Roth IRA income limits work. I hope you enjoyed the video today. I hope you learned something, and I'll see you soon.